So yes, recording is on.
We're all set to go. Awesome.
Yes, Karthik.
Hi, everyone. I'm Karthik. Ashna and I are part of the Sangam Ventures team. We also run an incubator called ASC Sangam. We're really passionate about trying to save us and our planet from the harmful effects of climate change. And we are here to make sure we can help you in that mission. So really happy to be back. And the topic for my discussion with you, hopefully it's more of a discussion with you, is around managing for growth. I think the last time we had talked about, building a customer-centric enterprise, driving towards initial startup sales, and assuming that within this short time frame, you're already there. We're going to jump in and talk about what growth can do to your startup and what you need to do to be prepared to manage for growth, right? And so we're back to the four quadrants and basically trying to understand how will you make money, right? So how will your business generate profits or cash flows for you so that you can pay your team, invest into the growth of your enterprise, and then ideally kind of get to a scale where you also kind of demonstrate climate impact. Right? And it's not something you do sporadically. So my biggest advice to you is rather than doing as much as you can, do as little as you can, but do it as often as possible, right? So whenever you're thinking about, driving opportunities in your business, the most important thing is to do it consistently on an ongoing basis and within a process, and not kind of something that you do like spring cleaning, where every few months you decide that you want to kind of get a stock of what's going on with your business, right? Uh, so I think the topic also to me and very dear to most of you should be about making sure that you don't run out of cash. And I think if you had to take one message back from today's discussion, it's cash is king, right? If you're a startup, if you basically are making your customers happy, the only other thing you need to care about is making sure that you don't run out of cash, right? So a third of the startups end up failing because they ran out of cash. And that does not mean that they ran out of cash because the business was bad. A lot of times they ran out of cash because business was too good, right? So it's important to kind of understand how startup growth plays into the need for cash that your business needs to grow, right? Like, so um, if you don't spend the time making sure that your business has the cash that it needs to grow, you're going to basically get yourself into a spot where just at the best of times, you're going to basically go out of business, right? So what you need to do is stress financial controls as early as possible. So just simple discipline about seeing where your cash is going, how much cash do you have in the bank, right? And then as much as possible, go through your business as systematically as possible, right? So identify opportunity, go through a planning process, figure out where your resources are, go through test and launch, right? But go through it systematically so that you have a sense around where your business is and where your cash is, right? And and so I think when you're thinking about growth, you're kind of moving beyond those initial sales into building repeatable sales, right? So you're kind of saying, hey, from now, every month I need to do at least 10 lakhs in revenue, or every month I need to grow my revenue from the last month by 5%, right? Or next quarter, I need to make a certain target in terms of revenues. And that ability to control how much your startup is growing is what gives you the power to kind of build your company forward, right? And that's what I would really like you to make sure you understand from today's discussion, right? And if you basically are looking at a growth scenario in your startup, it's going to be something that's going to start taxing your management bandwidth. It's going to start stressing your profitability because it kind of takes away from your business in terms of new customers, acquiring new customers, and it will surely eat into your cash reserves. So you've got to watch your cash very closely. Yeah. And it's almost like, you know, your startup is like a baby elephant, and it's really cute. You want to spend the most time with it, and it's a real pleasure to kind of see it grow. And then then you have something that's you know that you really need to feed every day, otherwise it's going to die, right? And so what you want to do is make sure you can manage the transition from something that you are enjoying, growing, and seeing changes versus uh, you know kind of something that just requires to be fed every day with a whole bunch of resources, which you need to then kind of scrounge around for to make sure it's there, right? And so when you're managing for growth, I think the first step for you is to make sure you understand your business model. We talked about it last time. So I'm hoping that a lot of you have tried to put a business model canvas in place for your business, just to get a sense of what does your business look like, uh, you know, in your head or in your way of thinking, right? So implement a business model canvas, evaluate progress, right? So that's basically what we're going to talk about. What do you want to monitor? What is it that's important to manage in your business? Identify things that are working and things that are not working, and then make course corrections. And that course correction is ideally going to end up being reflected in your business model, right? So maybe you want to start outsourcing something. Maybe you want to bring something in-house. Maybe you want to kind of stop selling and provide it as a service. So all those things will make a difference in how your business operates, or physically how your business operates from a cash perspective. And so you want to kind of tweak that early and kind of learn what does a good business look like for you. I'll stop there. Any questions that people have? Guys, just feel free to ask any questions. I don't think I have any. These are not the most fun, but it's important that you keep these concepts as simply as possible in your head. It's not very hard, right? It's important that you just kind of take it as simply in terms of being able to do it yourself as entrepreneurs. So you don't need a finance manager, you don't need an operations manager to do this. You as entrepreneurs at early stages of your enterprise should be able to kind of jump in and do a basic Excel of keeping track of things, right? So the most important thing is to paint a picture of what's happening in your business. I talked about this last time as well, and then paint a picture with cash, and then paint a picture with your business model canvas. So once you have those, then you can start playing around with seeing what's actually happening in your business, and then seeing how you can fix, right? So I'm going to give you a few models to think about, and you can think of it like a step-by-step guide of how you want to think about your business. And all businesses, just as I said last time, start with sales. If you do everything great in the world and you don't have any sales, you are not a business, right? So if you do only sales and you don't do anything else, you're still a business. Most probably a very tricky business in terms of either you're trading or you're basically fooling some people, but you're still a business, right? But if you don't have any sales, you're not a business, right? So all business thought process needs to start with sales. And for sales, we talked about these two aspects in the business model. The two things you need to think about is what are the channels by which you're reaching your customers. So that's going to be online, offline, abilities for you to kind of get your product in front of the customer, get the awareness about your product in front of the customer, and then basically looking at the fulfillment part, which is basically how do you get that product in the hands of the customer and get cash back, right? So those are the two things that you really need to kind of figure out for you to drive sales, right? The customer says yes and you can't get the product to them, then you still haven't closed the sale because they are not going to pay you before they get the product unless they pick it up. Again, so in terms of thinking about your business, start with revenue, right? Understand how your customers make purchase decisions. If yours is a bigger product, maybe it's an investment decision that they're making. If they're buying a tractor or if they're buying like a drip irrigation system, it's an investment and may not be a purchase, right? So how do they make their decisions is going to be critical. So when do you go to them, right? And then how are you going to drive these sales, right? Is it basically something in-house through a sales force or a business development person, or is it going to be through partnerships in marketing and channels with some incentives to basically make sure that you are incentivizing these channels to push your product over other options that customers might have, right? And both of those basically come down to two metrics: effectiveness of your conversion cycle. So how much time does it take for you to convert a customer, and the cost of acquiring the partner or the customer in terms of your time, team's time, travel, logistics, whatever it takes for you to kind of convert that customer into someone who's paying for it, right? So for you to kind of put that revenue driver in perspective for your business, you basically start with, hey, I have an individual or a unit, and then I'm going to spend some time, uh, you know, kind of going after the customer and basically trying to convert them. So the customer takes maybe, I'm in the market for a car. I'm going to basically go to the showroom twice. I'm going to drive the car. I'm going to do a whole bunch of things and, spend time with my purchase decision. So that time that the customer takes. And then basically what's the incentive structure for the channel or the salesperson to basically be incentivized to close the sale, right? And that's going to drive your economics till you get cash in the bank and the incentives that go out or anything else that goes out. The maturity cycle is important because if it's going to take 2 months for a customer to make a decision, right? And so you want to have a sale in October, maybe you should be talking to the customers today, right? That's the importance of having an understanding of your maturity or conversion cycle. Okay, I have a question saying identify deviations, right? So basically, even within this example, I can talk about it, but let me just make sure I take the reference here, right? So we are talking about implement business model, evaluate progress, identify deviations, right? So you have basically implemented your business model to say, hey, I'm going to have a sales guy who basically goes around in Delhi and tries to sell, you know, turmeric to restaurants, right? And that salesperson, your expectation is that he's going to sell about a lakh every month. Uh, and actually, it looks like, he did about 50,000 of sales. And then the next month, he only did 25,000 of sales, right? That to me is a deviation from your inherent assumption. So you might need to check how much you're paying him. Is that the right way for you to incentivize him? Is there a problem with uh, demand for your product in that market? Do you need to change something? So basically putting a plan where you kind of say, hey, this is what I expect. Don't just do that and then let the things flow, right? You want to kind of come back and evaluate your assumptions or expectations to what's really happening on the ground. And if they are not meeting those expectations or assumptions, you need to change your assumptions or change the way you are basically implementing your business. So if you are on the call, please feel free to unmute yourself and just ask questions, please. I'm not always looking at the chat box, yeah.
Hi,
And
this is Gaurav from Orgro.
sure,
Can I ask one question? In one of your
sure.
earlier slides, you mentioned that an incentive within a sales team or BD team. So
Mhm.
during an initial stage, like the startup like us, what should be the model for incentive for the staff? Like what percentage should we give to the staff so that they actively play their role in the market and bring the revenue better in from the market. So any suggestion or any technical input in such of like how what way we have to incentivize that? Like at what percentage we should do it so that there should be an attraction.
Sure. So, so there are two different ways to think about it, right, Gaurav? Gaurav, right?
Yes, yes.
Yeah, right. So there are two different ways to think about it. One, which we have seen in a lot of like engineering businesses that we work with, is that a lot of times you don't get professional salespeople, right? So you get somebody who's more like a technical salesperson, as in they don't come from the sales industry, right? So there, I think a lot of them require a minimum salary, right? So in those scenarios, I would say you would have to give them about 80% of the salary that they would have anyway gotten. So they are not kind of worried about having a minimum salary. And then having incentives where you basically have a, say, 80% probability that they're going to exceed what they would have made otherwise, and then basically have some incentive to actually do more, right? And that's where the scale incentives come in as well, where you can actually, as they do more sales, you could actually increase their incentives, right? And that's the same thing in terms of for the sales people, the professional sales people, you can have them on 100% incentive based system, right? And think of it this way: if you have somebody on 100% incentive based system, you can have an infinite number of them, right? And if your expectation or understanding on the first one, which is your non-sales person or a technical salesperson, there is a there is an amount you end up paying him to the sales. You just take the same ratio for a incentive structure for somebody who you're just putting on a pure incentive, and then increase it by a little bit, right? Because they're not getting anything fixed from you. So they'll only get money if they make a successful sale, right? Does that make sense?
Yes, yes.
Right? But always be biased towards in the early days, as long as you're not letting your sales commission eat into your profitability, right? You have some margin. It's okay even to give a certain amount of margin while it's hard. You're not known in the market. Startup sales are hard. It's okay to incentivize early, but when you do those, make sure that the quality of the sale is important, right? So that's where I differentiate between sales and BD. A BD kind of, for a business development relationship, is a customer who's going to keep coming back to you on an ongoing basis, and it's a relationship building exercise versus a one time sale, right? Like a vacuum cleaner salesperson who comes and sells to you may never come back to your door, versus somebody who is selling you an investment product might come and do that to you, do that with you every year, right? So think about the differences in terms of relationship based sales and the opportunities within that when you're setting up incentives as well. Okay, that I can't help it. Okay, so one of the easiest things for you to do that can help with your planning, but also help with your understanding of how your business grows, is to define or be able to ring fence a part of your business that basically repeats itself over and over again, right? So if you are a business which basically creates retail stores and you have different types of retail stores, you can basically kind of see what is the process and the overall kind of plan of how you set up retail stores, right? You need to go identify real estate, sign a lease, set it up, invest into whatever you need in the retail footprint, and then basically advertise locally and bring footfalls into your retail store. And then there is increase in sales on the retail front till it kind of gets to some kind of a stable level or something like that, right? And that basically repeats itself every time you open a new retail storefront. Similar thing happens when you create like sales routes. So if you're basically doing food delivery, or you're doing grocery delivery kind of a business, then you might have each person come up with a sales route that they manage, and then within the sales route gradually you have more and more customers that kind of come onto the sales route, and then that needs to be managed. And then every time you decide you want to grow your business, you most probably add new sales routes, add new customers into existing sales route to grow your business, right? So the same thing can be done in so many different ways depending on your business. But I highly recommend spending some time thinking about what is the unit model that makes the most sense for your business. Even if you're in an FPO kind of scenario, maybe it is driven by a processing center, or it's driven by a different aspect of your business in terms of channels. And like basically think through what is it that you spend the most time on and create a new unit of to grow your business. Yeah, and that works even when you're expanding across geographies, saying, hey, now I sell in the local northeast region. Now I'm going to add Delhi as a sales opportunity, or I'm going to go to the Mumbai market, right? And that basically has a process.
Karthik, I just want to
Yeah.
come in with perhaps an additional example of a sample unit that might be applicable to some people. Is if you are working with farmers and you can imagine how much it costs or how much benefit you'd get from onboarding an additional hectare or acre of land, I think that can be a unit model that can be applicable for some businesses here. So like for every hectare of agroforestry land that we open up, we need to spend this much to start it up. We need to get this much money back year after year. I think that's another unit that could be useful for people.
Sure. I think so. My advice on that is to keep it almost like not at a task, but at a project level, right? Like opening a retail storefront is a project, right? Hey, I'm going to go and open a store in XYZ location or in this neighborhood. It's a project which has like a start and an end, and it basically has a life cycle where your sales grows within that project, right? So when if you're doing a new location or a new set of farmers together, right? Like a self-help group of farmers together, or you're basically having that ramp up cycle, it could work. But if basically a hectare is a big undertaking and it requires a project management kind of aspect to it, I would say working with that makes the most sense.
Perfect. I really think what you said about thinking of it as a project, like every project that you bring on, what does that? I think that's a really useful mind shift that people might have gotten from that. Thanks, Karthik.
Yeah, hi, this is Rajul. Am I audible?
Yes, you are.
Yeah, I have a query here, Karthik. So thing is that kind of solution some of the companies have, and including mine, we have a kind of a hardware IoT platform for precision ag.
Mhm.
And
Right.
here to expand to different geographies as a startup, it becomes difficult for us to have a team everywhere or having a center. So I'm trying to partner with some kind of a team which is already existing in that particular state, and wanted to use have them as a service and installation and service partner. Now I want to understand, in such a case, they can also become a kind of distributor if they are a well settled company. So
Right.
when we have them as a service partner, like, okay, installation and service, what should be the kind of model? And let's say if they become distributor, and let's say we have a specific percentage of margin for that for that, then the installation and service, does it become part of that?
That's a very, very specific question, and it's something that comes up very often. So thank you for asking that. Right. The way I advise a lot of our startup CEOs, right? Uh, if somebody is, say, doing an R&D job in your company, right? And then that person says, hey, I'm going to basically be doing this, but I'm happy to help you with sales. And they go out and incrementally do the work around technical sales for you, right? I think what you're doing is basically using an in-house resource to get something done for which you would have hired somebody, right? So maybe you don't need to pay them twice the salary, or like pay them their salary plus the new person's salary, but think in those contexts, because what you want to always think about is to pay depending on the value that somebody is creating for you, rather than paying based on how much is okay to pay, right? So if somebody as a partner is kind of saying, hey, I'm starting with distribution, but as a distribution partner, I can actually do service and other kind of activities for you, I would say if you budget each of those separately and have margins assigned to them, then one partner doing all of that is, you would compensate them across that percentage figure that you add up, right? But then typically most distribution partners will at least do certain level of fulfillment. Maybe they won't do repairs, but they will do replacements, right? So I think the important part is to understand how much a distribution partner is expected to do, and different distribution partners are slightly different. But I would say, again, right, in the early startup days, the customer is more important and sales are more important, right? So don't worry too much about like how much you're giving up in terms of the margin. If your startup and your product basically are driving business for them, you will basically come back on the table and you can negotiate improved prices with them. But the important part is to make sure that you do good contracts where you basically assign value to different aspects of what they're doing for you, uh, to be linked to what you're going to compensate them with.
Yeah, thank you, thank you.
Karthik, there's another question in the chat box from Vidyut.
Okay.
Vidyut,
Okay.
would you like to?
Yeah, hi everyone. Hi Karthik. Vidyut here from Takajar. So I just had a quick question, which pertains to a stage when the product is yet not in the market. So in this scenario, I've faced a constant tension between spending less and extending the runway of the company versus paying for resources that might get us to the market faster. So I was just wondering, is there any philosophy or thought process here that can be adopted that can help me frame the usage of funds better, or is it solely based on my own discretion of how I want to use the funds that are available to me right now?
Sure. I think so. At the end of today, hopefully you're thinking more about cash, but you're also thinking about growth, right? So this is basically always going to be a problem, right? So if you're going to try and push for moving faster, having growth, you're always going to be short on cash. That's always going to be a tension that you're going to be requiring to balance, right? So my way of thinking about it, and everybody is a little different, right? But my way of thinking about it is there some level of market building or going to market activities that you can do that can actually generate cash for you, right? So can you go and ask your customers to give you an initial deposit, right? Like somebody, even like a Ola, when they did this electric scooter thing recently, kind of made all the customers pay a small amount of money to book their scooter, right? And that's something that everybody does. Is, you know, they say you got to wait for 2 months, but please book it now, otherwise there's a long wait, right? So you can kind of do things where you actually can make your marketing activities extend your runway rather than the other way around, right? But that's not always, you know, obviously generalizing and saying we should all do the same thing that somebody else did doesn't help. Uh, but my sense is whatever you can do to get to sales faster is what I would prioritize in your business. So if you have an option to do more R&D to get the product right, or you can basically sell something to your customer with the caveats about where the product is at and their understanding that you could come back to them with an improved product in the future, and you would like their feedback, you know, a lot of customers might be willing to pay for it, right? So be biased towards sales at all times.
I think here uh, hello.
Yes.
Yeah. Karthik, this is Rajul again. I have one, like on the previous question and your suggestion, I have just one idea, and I just want to ask that and get validated by you. So see here, most of us are into agri domain and our customers are like common customers, farmers, right? Maybe we are giving a different solution, and maybe, but we are still targeting those rural market and small and marginal farmers. So is there a way, because under this cohort or not, maybe under any cohort, that we can actually come as a group, and because everybody is very constrained on resources, because we are reaching out to the same people as a group and as a collaborative, maybe we can reach out to the market, then we can actually reduce our whatever hiring and all, we can share resources, we can because we are reaching out to the same people, maybe we can form a kind of a group and collaborate, and that will also develop a team spirit, and overall holistically we can actually approach the farmer, give them a complete solution. So what do you suggest? Is there a collaboration possible here?
Absolutely, right. And there is a lot of opportunity in asking your friends for help, right? Like, you know, that always is the cheapest and easiest way to get your business started, right?
I'm not saying about friends here, I'm thinking about the
So
people who are
I'm
present in
saying
this call.
in the cohort,
I have
there are people who might
I
be
have
able
this
to help
suggestion.
you. Sorry, go ahead.
Yes, sorry. Can I?
Go ahead.
Yeah, but madam, that was a good thought. But what happens generally is, though we are all into the agriculture space, I tried myself personally with the group also, because each person, though we are into agriculture, the market segment differs and the market product fit again it might differ. So if the market product fit suits for both of us in the same area, then the collaboration or the cross linkages within the members can definitely happen. Why not? I mean, it can definitely happen. With my experience, like being in a very large agri entrepreneur group also, so we've been trying to collaborate, but we're not able to get any synergies properly, because either they have a different kind of solution addressing to some other segment where my market product fit doesn't match. So that is how it happens mostly. So we should understand,
Absolutely,
instead of
right.
saying a larger group. Yeah. Am I right, sir?
So yeah, absolutely right. So obviously, you know, your product needs to match the customer base of somebody else's business to be able to kind of collaborate and kind of cross sell, right? So it's called cross selling, right? But what I'm trying to say is within a cohort like yours, there is trust that's built up. So you should actually be talking to each other and exploring opportunities to cross sell, to cross validate. So, going to somebody and saying, I don't know if my product makes sense in the south of India, it works in Maharashtra. Do you mind taking a few of them and testing them out in your region, right? And that could be as good an ask as like saying, could you sell my product to your customers, right? So if you don't know if there's a fit, maybe exploring if there's a fit is as good a proposition as well. Yeah. But I think to come back to the idea around the unit, uh, you want to kind of really think about how you want to grow your business, right? And to this conversation around, hey, can I kind of sell it to a few of these other companies in the cohort? Is that going to be good in terms of a business plan? Is that like a plan, or is that basically hoping that something clicks and then you're going to move forward, right? So think a little more systematically, and maybe you can use your cohort mates to test ideas or assumptions more than you can to just drive business growth. Yeah, but you can also get referrals and recommendations, right? Now, in terms of thinking about your business, and this was just basically more from the learnings from the last land accelerator cohort, right? I think you, as land restoration entrepreneurs working with you know agriculture, farmers, non-timber forest produce, tribals, that ecosystem, it's very important for you to kind of decide on what is it that you want to focus on in the early periods of your startup growth, right? So you need to understand what's your sourcing dynamics, like what are you going to be sourcing from your farmers, or what are you going to be sourcing for your farmers? What's the value addition, or what's the value that you are bringing to this ecosystem, and then kind of the dynamics around the sales or the demand for what you're doing, right? And what that means is, I think you need to decide on, and I think this is a bit more of a perspective on if you're basically helping farmers or tribal NTFP ecosystem with sales, is to pick your positioning, right? So either you want to kind of take a higher premium pricing, brand based positioning where you want to capture as much value as possible, right? Or you want to ensure offtake, so you want to drive and ensure that as much of your volume of supply is sold, right? So that the farmers get some minimum amount for their produce, or you basically are worried about perishable products, and so what you want to do is kind of reduce the risk of loss, so your value addition and your driver for sales is driven by how you can kind of offload most of your products to somebody in the market. Might not be a customer, but might be somebody who does further processing, or reduces the risk of loss in your product or produce, right? And so, oops, right? So if you are basically thinking about building a business based on a brand or a premium pricing, then pick the most valued or most famous product from the ecosystem that you're coming from, right? Like especially if you're looking at indigenous produce, if you're basically working with very specific types of farmers, then pick what makes the most sense in terms of what that region is famous for, right? If you're basically looking at volumes, then you want to look at your farmer base and pick the top 2 products by volume that you want to kind of drive volumes for, to ensure that the farmers get a meaningful remuneration, right? And then obviously if it's perishable, then look at the most perishable products. What I kind of repeatedly saw in a lot of land restoration entrepreneurs is they were trying to do all 3 at the same time and not being able to achieve either of the 3, right? And so it's important, if you're working around driving markets for your ecosystem of farmers, then you want to kind of pick one of these 3 positions and then build your business. But that's very specific to land restoration entrepreneurs who are kind of helping farmers with sale of produce. But please stop me if you have questions on that. Right? So again, back to what you want to kind of spend time on is stressing your financial controls. So I'm going to switch a little bit of gear and talk a little more about finance and cash flows. Right? So once you kind of have, we talked about this, right? Like how you're going to focus on sales for your business. The next step for you is to start looking at breaking down your business into markets that you're kind of working in, either by geographies or by sectors, how you're building your order book, how you're basically kind of getting your revenue mix from a different set of products or projects or channels, or even it could be from like consulting revenue or kind of brand licensing or any of those things, right? But kind of making sure that you understand where your revenues are coming from and what are going to be the key levers for you to drive sales is going to be extremely important. Right? And I'll go through quite a few of these in more detail in the next slide.
Karthik, just a comment. Wanted to say this slide I think is really instrumental because the information that the entrepreneurs are going to be collecting or I guess collecting or analyzing is going to be really important for investors to see as well. So there's the management part of it, but then once you understand your management part of it, it's easy to extract that and show it to investors. The revenue mix is something that most investors will find really, really important. So just wanted to highlight that. Thanks.
Thanks, Amanda. And feel free to stop me, but I'm going to go through each of these in terms of examples. So typically for your revenue mix, what you want to think about is where your revenues are coming from, right? On a month-on-month or a quarterly basis, and then kind of seeing, if you see on the far end, basically the percentages. So if you look in this scenario, AMC or asset management is what is kind of providing the most revenue for this startup, right? And then there's a fair mix of revenue coming from product X and from like projects that the startup is doing, but product Y is really not adding to the revenue, right? And that might be a signal for you to say, hey, maybe product Y is not worth me spending 2 days a week on. Maybe I should just kind of stop focusing on product Y, right? So the revenue mix really helps you kind of decide where you want to focus your time on, and that the same revenue mix concept can also be looked at from a profitability mix, right? So you kind of come down from revenues to gross margins, and then you can look at like your profitability mix and see where your profits come from as well.
I have a question, sir.
Sure.
This is Sudarshan from Wipro. So generally,
Sudarshan, I can't hear you very well. Can you speak up or get closer?
Yeah, is it audible now?
Yeah. Yes.
Yeah, generally in the financials or whatever it is, expectation is month on month, the growth should be shown. The growth curve on the top side should be there is the expectation. But if for a project or a venture which is focusing on seasons, so how will be the general thought process of an investor? Like Even in that, because the little lean seasons and peak seasons in our venture, my ventures especially, it's a man-animal conflict problem what we are trying to solve across India. So based on the our cluster model, during the season of paddy ground, few target crops are there. So in the particular seasons, we will be focusing, and then there will be a lean season. So how will they generally look at it, sir?
So good. So I will come back and talk about investors towards the end of this, but to step back, right? That's a very good point you brought out in terms of seasonality in your business, which is actually a reflection of the seasonality in your customer's business, right? So
Correct.
farmers have seasonality, so you have seasonality, and recognizing those is very important, right? I kind of talked about that sales cycle and all of that. I think I should make sure I add seasonality when we are talking about a lot of things within agriculture, right? So thank you for that. So and within seasonality, I would say what you, and this is kind of a focus of this deck is more focused on you trying to manage your business, not so much showcase your business to investors, right? And so for me, the question for you is, hey, you have seasonality in your business, but obviously you have to pay your team every month, right? How do you handle that?
The burn keeps happening. The cash keeps
Right?
burning month on month.
Right? So I think the important thing for you to recognize is I have seasonality in my business. So my expectation is that most of my revenues will come in August, September, and October, and rest of the months of the year, I don't really get cash in. And we have startups that have that scenario, right? But what are they doing the rest of the time of the year? How can you get your startup to be more productive on the other times? What do they do? Where do your revenues come from, right? So maybe if you have a seasonality in one crop, then maybe there's a cyclical crop that you can serve, or a different region that you go to and like serve that. It's a different season, right? So thinking through those will really help you make sure that you're managing your business well. And that could include like saying, hey, we just work for 3 months of the year and we make enough money that we're fine. And that could be perfectly fine as an answer as well. And the reason I'm
Okay.
saying that is because if you are working with investors, most investors are investing in growth,
Okay.
right? So if investors are investing in growth, the bigger your company gets, the bigger the burn gets.
Okay. But
Right?
what we have
So,
done, sir, like to mitigate this, maximum in our model, we have to understanding the seasonality in the growth in the future part also. We have taken most of the people off roll. The on roll people are lesser, and we have taken off roll people based on the seasons, and they'll be paid only on the use case thing. So that is how we are planning. But there is a limit to reduce the on roll people also to beyond an extent. So that we'll have to take it.
right. And that's exactly where I was coming to, visualizing your business, putting that in the business model. Who are your full-time employees? Who are your part-time seasonal employees? How do you kind of find them? All of that is going to become important, right? And
Okay.
so showcasing that to the investors is what you need. So for most part, if you as startup founders demonstrate that you understand your business well, right? You understand your business well operationally in terms of like what goes where, who does what, how to get done, right? How things move around in your business. If you can explain how your customers and vendors and everybody else who are outside of your business that work with your business kind of engage with your business, right? Which is kind of the business model for this. And
Okay.
you can explain, what happens to the cash, right? So if you make money for 3 months, do you keep that money in the bank and make sure you don't spend it so that you can pay salaries for the rest of the year? Those kind of things are important,
Okay. Okay.
right? So if
Fine.
you can explain to somebody those three aspects, then investors are going to be fine with funding your business, right? So the
So the
key is to
month
make
on
sure,
month cash flows are important. Wonderful. Yeah, got it.
yeah. So the percentages of growth and stuff like that is mainly around saying, can you grow your business if you wanted to, right?
Okay.
Like if you made a certain amount of revenue last year, if I gave you money, can you make more revenue next year?
Okay. Okay.
Right? And so do you know what levers to pull? What do you need to push forward? What do you need to invest in to go to like 2x or 3x your revenue next year?
Okay. Okay. Fine. Got it, sir. Thank you. Thank you for the detailed explanation. Thank you.
Um, and one of the things you can do to assure uh, revenues going forward, and it also links to kind of if you have sales cycles, is building an order book, right? Basically keeping tabs of all the customers who have shown an interest in buying, and then basically setting an expectation around how much they might buy, at what probability, and then basically having a target of making sure you can close those customers within a period of time, right? And if you kind of go through some sales books or go through and understand how to use a CRM system, you should be able to kind of easily build an order book so that you and your sales team can set targets and meet those targets on a monthly basis or quarterly basis. That's exactly how most businesses operate globally, right? Building an order book can be extremely valuable for you to ensure that you have enough cash coming in from your customers to pay for your business. Does everybody understand this order book, or if somebody does not, can you tell me what you don't? I'm happy to kind of explain it again. But building an order book is how most of our startups survive.
Got it,
Just
sir.
one
Understood.
quick question. What is probability percentage? Is it that the order hasn't come in, or is it what is probability
Yeah,
percentage?
so the probability percentage is that the order has not come in, but what your expectation is of the order coming in, right? So typically, a lot of the order book building goes alongside sales pipeline or funnel process, right? So at a probability of 100% might be that you have received the purchase order, but you have not still received the money, right? Or you have not fulfilled that order yet, right? Versus customer number three, says 90% because you sent the purchase order, they haven't signed and sent it back to you, so it's still iffy, but very highly likely that they're going to sign it and send it back, right? 75% might be when you are in a process where you're still negotiating the price, but they are very keen to buy, right? So just these are subjective probabilities, but what it gives you from this is, the likelihood that next quarter you will make, 3 crores in revenue, right? Or yeah, in this scenario is 3 crores in revenue for next quarter.
Sure.
Right? So
Thanks.
that allows you to plan. And so obviously if you are in the early stages of your startup, test, do early adopter sales, do more sales with customers who will give you feedback and spend time with you, just so you can also improve not just your product but your sales process on what made the customer buy, right? Knowing that will give you upper hand in driving those sales. Two, build an order book and a pipeline. An order book and a pipeline is also very interesting for an investor, right? If you go to an investor and say, hey, we have 1,000 customers waiting in line to buy our product, or we have 80% probability of doing X amount of business within the next 6 months, and here is the list of those customers. That's what gets investors excited, right? Because they know you're already building the business forward, right? So an order book is a great way to get investors excited, but also kind of keeping yourselves in the driver's seat to push for sales targets that you want to meet, right? And when you're talking to investors, and this is something that works really well, is if you are pre-revenue. So let me define pre and post, right? Your pre-revenue, if you can't tell me today what your sales in the next quarter is going to be, right? If you're post-revenue, you should be able to say what's going to be your sales next month and what's going to be your sales next quarter and what's your expectation of sales that you're going to close by the end of this year. And ideally it's growing as well. So that's what makes you a revenue startup, right? If you don't have that, you're better off saying that you are pre-revenue and you have really good customer interest and lots of sales, but you are getting to a point where you can start driving revenues and creating a formal growth path, right? And that will get investors still excited if you show them an order book, then saying we have revenues, because we have seen multiple times that startups, even if they have like little sporadic sales, say we have revenue, and then when the investor kind of digs in and looks for an order book, looks at the revenue numbers and sees there's no kind of like consistent trajectory or traction in your sales, you're not really a revenue startup and they would not get excited. But if you said there's a lot of potential, there's a high probability that they might still believe that you will get to revenue and invest in that potential. How am I doing on time? So 7:30. So I got.
We have about a half an hour left,
Okay.
I think.
Okay. So I'm not going to get into to working capital and maybe I'll just kind of stay with the high level of understanding your business and from your P&L perspective. But I'm happy to either dig in there or spend more time answering questions, and then we can always maybe find some time to do this session again. Or go through at least the working capital part because that takes a bit of time. But so just again, right? So we talked about revenues, we talked about driving sales and understanding your revenue mix, and you as the entrepreneurs being in the driver's seat, controlling what's happening in your business. So where are your revenues coming from? What kind of channels? What kind of products? And you orchestrating that, right? Then the other side of it, once you have revenues, and again, right, revenues are more important than anything else. So once you have revenues, stepping back and then looking at what's your cost of fulfillment, right? What's your bill of materials? Like what are you selling, right? What's your labor cost? What's your utilities, your rent? All the things that go into fulfilling that customers need is something that you then start focusing on and trying to understand the margins in the business, right? So the important part is to kind of make sure you set expectations around the time and cost of fulfillment, right? And so the first step for you is if you put in the revenues and then kind of had a sense around how you're going to grow your revenues, then you kind of start looking at what are all the costs associated with building your business. So what are the cost of goods, what's the personal cost, what's the administrative cost, and then getting to something called EBITDA, which is just purely your profits after you've put in all your operating costs into your business, right? And as an entrepreneur, if you just manage for your operating profitability, it's a good first step, right? You'll most probably end up doing it more from a cash basis, and that's okay. But whichever way you do it, make sure you are kind of focusing first on revenue and then making sure that the other things from a sanity factor are being managed well. Sorry, I see more things in the chat. There's some coming right?
Hi,
So,
Karthik. Sorry to interrupt. So that was me. Yeah, I have to make an announcement for the cohort. The attendance link is there in the chat box. Please mark your attendance. Thank you, Karthik.
Hi,
sure,
Karthik.
no
This is
worries.
Rajiv here.
Yeah.
Hi, I have a small question. I think the presentation looks pretty cool, and this looks actually very great when you're dealing with a company which is into product driven. And how do you actually manage the growth when you're into service sector? When we say a service sector which we generate revenue only to our services, how do you actually manage in that scenario? If you can just give a little insight around that, that would be great.
So you faded out at the last bit. You said, what do you do?
In the service sector, I said, in case we have to manage in a service sector, how do I actually manage? If you can give us a little insight around the, how to promote your services in the market and how to generate revenue or how you generate fees for it. So it will, if you can give us little insights around this, it will be great.
Sure. So services sectors are so much easier than than doing product sales, right? If you're going out in the market and selling mangoes or selling bikes, you're going to go out and sell more to newer customers all the time, versus when you're in a services style business, you end up doing a lot more of like long-term projects, right? Or you typically end up looking at long-term service contracts. And if you kind of design your business well to have these kind of long-term service contracts, what you need to account for is just the cost of acquiring that customer and making sure you don't spend more than the value of that service contract, right? So in a lot of the service style business, I think what you need to manage for is basically the cost of acquiring the customer, how much time you or the team spends in getting hold of the customer, and two is your bench strength, right? And the best thing for you to do is to make sure you, as a business, have a strong leadership team, which is basically what drives your sales, but also the business team is really good at training, right? And the reason I say that is because if you're going to have a smaller bench, then you might want to ramp up the number of people in your business fairly quickly if you get new projects. And when you do that, what you need to kind of account for is how quickly can you train and bring on board new people in the team, right? Does that make sense?
Yeah, that's right. Yes, it does.
All right. I see more. Everybody's marking their attendance. Please do mark your attendance. So actually, what I have left is the working capital analysis piece. So I just want to stop here, and before I jump in, maybe give a few minutes more. If anybody has questions, otherwise I'll go through it, and then we can always take questions offline as well, or maybe take a few minutes post. Any other questions on mainly around setting up the costs and other aspects of your business, right? Again, if you see, the consistency is still what I talked about. Actually, let me just go across, right? Is around the right hand side of your business, right? All my focus for you in the early days of your business, if you're not uh, growing like crazy, then your focus needs to be around growing like crazy, right? So the focus needs to be on your revenue, the customers you're trying to engage, your channels, your customer engagement, and then your value proposition. So just stay on the right side of your business, and the other ones are what you need to do to basically ensure that uh, the revenues keep coming in. But the focus for you as entrepreneurs need to be around driving that revenue first and foremost, right? So that's why if you see most of
Karthik,
my
I have one question.
Mhm.
Yeah, this is Suresh from Sasa Enviro. These parameters related to cash flow management and capital management, are they different from startup to the well-established firms?
No, they are not. The biggest of companies have the same kind of you know basic calculations that they have to do as you would from your first sales in your startup, right? Nothing changes. It's just the
Okay.
complexity and the numbers of parties that you're dealing with or handling, or number of geographies that you're dealing with, and tax and GST and all those kind of things will come in. But at the end of the day, the basic economics and the basic calculations are the same, whether you are a Tata or a GE, or you are a startup with the first month of sales.
Okay, thanks.
Okay, so we got like 20 minutes. So I'm gonna try and go through the working capital analysis, but stop me at any point if you are not clear on any of the concepts, right? So what you're doing as a startup is basically going through what's called a cash conversion cycle, right? So in your business, you take some cash, go out and buy some raw material for your business, which is your purchases, right? And sometimes you don't pay for all of it. So you kind of say, I owe you a little bit to your vendors. That's your payables, right? And then all of that now raw material sits on your books or in your factory in the form of inventory, right? And then once you have converted that into finished goods, you do sales, and the expectation is that your customer will pay you right away. But not all sales customers pay you right away. They might pay you a little bit later. That forms receivables or money that you are expecting to receive in the future from the customers. And once you get the receivables and the sales, you kind of convert to cash, and you're back to the cycle of going through again, purchasing more, and then selling, ideally with a profit. And so gradually you keep growing your cash, right? That is the idea for most part around cash in your business. Is everybody with me on each of those? So purchases is for you buying raw materials. On the other side, sales is basically you selling finished goods, right? Your payables are what you owe your vendors because you made purchases but didn't pay for all of it. Your receivables is what your customers didn't pay you, though they bought stuff from you and they said, I'll send it to you later, right? And your inventory is actually the goods that sit with you before you do sales, and your cash is your cash, right? Um, so make sure you kind of stay with those ideas. So So Dr. Nagavini, I'll just take that offline with you, so you can just message me. So I think staying with the working capital analysis, right? Again, I'm just showing the same thing in a different representation, right? So you do sales, and then your cash gets delayed, it becomes receivables, right? But if you do sales and you convince your customer to pay you even before you sold them anything, that becomes advances. Advances are good, right? Customers paying you before they even get something from you is a great thing. They're funding your business, right? Once you basically have spent and built inventory, that's it. That's basically your cash now converted into materials that you can't use to pay your employees or pay your vendors or do anything. So that's basically sucking up cash in your business. That's bad, right? But if you basically convince your vendors to give you credit so you don't have to pay them for everything that you bought from them, that's your payables, and that's again delaying outflow. That's great, right? So all the blue stuff on this screen are good. All the orange stuff, you want to make them as small as possible. The more the orange stuff becomes small, more the blue stuff becomes bigger in your business, the more cash you will have in your business, right? The idea is, as much as possible, don't give cash to anybody, and as much as possible, take cash from everybody, right? So if your customers can give you cash in advance, take it. If your vendors will allow you to give them cash later, take that offer from them, right? And that basically can drive what your working capital gap will be, right? Uh, Sorry. So let me just go through some examples to make sure we talk about how to look at your working capital, right? So when you purchase inventory, either you take that inventory and use it to sell, right? So then it goes into your profit and loss statement in the form of COGS, right? We just did that operating margin. COGS basically goes into that operating margin calculation. If you take the inventory and don't do anything with it, now it sits on your books or in your as inventory, right? Now, if you buy more inventory, your inventory goes up and your cash goes down, right? So you basically converted your cash into inventory in your books, which basically means, it doesn't have any impact on your profits, but it reduces the amount of cash you have in your business. Does everybody understand the idea that if you bought stuff and kept it in your inventory, it has no impact on your profitability, but it basically reduces the cash you have in your business?
Yeah, definitely. Because you're talking about the balance sheet items and P&L items separately. So, yeah.
Karthik, I can also see we have a hand raised from Hardik. So Hardik, would you like to ask your question?
Yes, sure. So hi Karthik, this is Hardik from Haniveda. So my query is more from the point of view of how an entrepreneur should think in a specific scenario. Mm-hmm. So, I mean, as an entrepreneur, you are passionate about what you do. And in my query, it's about what you do, I mean, supply or the manufacturing side of the industry or the business. Now, for the survival and for the growth purpose, you need a product to generate revenue. Now, when we talk about the product, it's about the demand side of the industry or the business. So, I mean, what should I do if I see that the product side of the market is saturated? Let's say out of the activity or the manufacturing activity that I have been doing for some time, and when I am ready as a venture to launch my product, and then I see, okay, fine, there are many other traders who are not actually manufacturers, but they are just trading the product, and the market is full of it. So I still feel the supply side, I'm still feeling a calling within me to work on supply side. I still like doing manufacturing activity. I'm passionate about it. It has a conservation and other win-win scenario for everyone, every stakeholder. So how should an entrepreneur think in this situation?
Sure. I think the, the passion should show in the product, right? So if you are making, I'm assuming, honey or any produce, and you are basically putting your passion in it, what you need to figure out is how is your product differentiated in a crowded market, and how do you again demonstrate the uniqueness or the higher value of what you are kind of bringing to the market to the customer, right? You're most probably kind of making sure that there is not as many additives. You're most probably making sure that it's sourced ethically, or it's basically sourced from wild honeys versus grown in a farm, or doesn't have like certain ingredients that it should not have, or it has ingredients that it should have, right? And you need to highlight those. And in your case, I would say, when I was talking about those three differentiations, right? One was, are you selling something that is perishable, or you're selling something that you need to kind of do as much volume as possible, or you need to position yourself as a premium brand. In your case, given how crowded and kind of too many people who are not really kind of uh, manufacturing anything, but they're just traders, for you it's important to kind of show yourself as a premium brand, one, but two, actually drive value by connecting to your origin to retail story, right?
Okay.
Where are you sourcing from? How are you processing it? Like, are you marketing your processing, right? Are you showcasing how you're kind of making it, right? So I don't know if you've seen uh, companies that do artisanal chocolates, right? It's coming up in India now. There are companies who do artisanal coffee, right? Grinding coffee is not like very different. There are enough people who make like ground coffee, but there are still people who have a premium reach in the market, and there are people who care a lot about those brands and actually go out and buy from those brands.
Okay.
Right? So for you, the most important thing you can do is, yes, you have the manufacturing. Stop focusing too much on the manufacturing. Focus on your revenues, right? Focus on your customers. Focus on the positioning of your product, and get to a point where you have a lot more customers wanting your product and you don't have enough to supply, right? You want to be in a supply problem scenario. You never want to be in a demand problem scenario.
Okay.
Right? Which is why, to me, I always kind of recommend, if you know what you need to do and you know how to do it, great. Stop, do a small amount of it or do it as needed, but tell your customers to wait for a month. But market and reach those customers who will wait for a month or 2 months to get your product, especially if you're seasonal or any of that, right? Doesn't matter. People will wait for your product if they love it.
All right. So yeah, so
Right?
market the process. Yeah. Yeah.
Focus on the marketing, focus on the positioning, focus on bringing every aspect of your product. Is not just the honey in a bottle. The product is basically how it got there.
All right. Yeah. Thank you.
Sure. That was you, Hardik. Any other questions? Okay. So I'm not sure if I want to plow through this because it gets a little more complex as we go. But I think so. I will try and get to the end of it, and then maybe I'll explain some of this in more specifics, right? So the main thing you want to understand from analyzing what is called your working capital, right? Well, we saw that conversion cycle of cash becoming, used for purchases, becoming inventory, becoming payables, becoming sales, receivables, and then coming back into your pockets, right? So the way to think about a lot of your working capital is if you have inventory sitting, for you to convert into cash, you need to sell, right? So you need to convert that inventory into cost of goods sold. The speed at which you kind of are clearing out your inventory is your inventory turnover, and that's your cost of goods sold over inventory, right? Because basically, how much are you depleting your inventory? And you want to deplete it as fast as possible, right? So you should never have an inventory. You should have an inventory problem at all times, right? The same thing in terms of receivables, right? If you have revenue, you don't want your customers to be sitting on your money for too long, right? So you want your receivables from your customers to be coming in as fast as possible. So if all your sales, none of your customers paid you, then you don't have any cash in the bank, right? So you want to get that receivables down to as small as possible, and that is basically looked at from a receivable days, right? And it's linked to how much time do your customers sit on what percentage of your sales, right? So if your customers pay you only 50% and then they pay you 50% later, but they take 90 days to pay it, that's horrible, right? Like now you're basically waiting for them to pay so that you can pay somebody else or pay your team. And you want to bring that down to be as small as possible again, right? Payables, on the other hand, which is you paying your vendors, try and talk to them to get a better time from them to pay them as much as they would be okay with, to make sure that you can again be conservative on cash in your business. If you kind of drive these three to the best level, so inventory turnover needs to be high, days receivable needs to be low, days payable again needs to be high, you will get yourself with as much cash in your business as possible. And the most important thing for you in your business is to look at cash coming in, cash going out, make sure there's more coming in than it's going out. Cash is king, right? So when you're managing for growth, the most important thing you can do for your business is to manage for cash. Okay? So if you can take away two things. So one is actually from last time we spoke, and something that Hardik brought out, which is focus on sales and always have a problem with manufacturing, have a problem with team, have a problem with, you have so much sales, but you don't know how to kind of make sure or keep up, right? But don't have a cash problem with sales, right? Drive more sales and manage for cash. If you can do those two things really well, you will figure out how to grow your business safely. And that's all I had for today. So if anybody has questions, I'm happy to stop and take next few minutes to answer.
This is Sudarshan from Vivipro, sir.
Sure.
So basically, in the expenses what we are provisioning. So are the promoters basically allowed to take salary at least to what extent? Is there any cap on all these things? The founder promoters are also playing a key role in driving the entire team, sales team, because I've been hearing from a few people, what I've understood, I don't know whether wrong or right, that the promoters generally they are not allowed to take salary initially. So is it right or is my understanding wrong?
Okay, so let me put it this way, right? I think there's a bit of a mismatch in terms of thinking about, and it's a very separate question altogether. It has no context to what you're talking about today, right? But think of it in terms of all the employees in your business and you being an employee in your business, right? And you also happen to own the business, i.e., you own all the upside opportunity or the profits that come out of your business, right? So now, if you decided to not be the CEO of your business, somebody would have to be the CEO and they need to be paid.
Correct, correct.
Right? So to that extent, it makes sense that if you are going to end up being the CEO, you should be paid, right? But you are being paid to a large extent also from the increase in your wealth in terms of your ownership of the business, right? So now stepping back, if you think from an investor's perspective, an investor is putting in a certain amount of money and say owning 20% of your business, now you own 80%, right? But they put in money to, kind of get that benefit, right? You didn't put in money, you just put in sweat or, whatever else you put in, but you own 80%, right? So now the investor is asking you, if you own 80% of the business and you're going to be driving that value and you own that, shouldn't your salary be relatively lower because you are otherwise taking that money and going to pay yourself? Right? You need to be compensated.
I agree with your point of relatively low, but my point was like generally they say that there should be zero. Is it right? But that was surprising to hear.
So so step back, there's no regulatory requirement or any other requirement of a promoter not taking salary, right? There are different aspects in terms of directors, independent directors in your business being compensated, having regulations, but any promoter is very in a for-profit business can take a salary.
Okay, thank you.
That's one. To just think of your compensation independent of whether you're a promoter, you're a CEO, you're a CXO in a business, always being in the form of two things, cash and your ownership in the business. That's why people have ESOPs for early employees and all of that, right? So always think in both those terms always, and you will get to a fair number that makes sense.
Okay. Thank you.
Sure.
I wanted to let everybody know that we're 3 minutes over. I believe that your team might be having a call right now, Karthik, with somebody. So wanted to give you guys the chance to say farewell and make it to your next call. So if that's true, Karthik, perhaps you want to have just a few seconds to say farewell and then jump off. And then Kavita and I can close out the session.
Thanks, bye.
Thanks, Karthik, for joining us. Thank you.
Thanks.
So then just the closing remarks is we'll see folks. We want to thank Karthik and Ashna from Sangam Ventures. We're doing this together. We want to thank y'all for joining us. And next week we'll also be starting at 6:30, but it's going to be starting right on time because we're having a double header, like we said. So it should be a really transformational session. where you'll be able to pull together a lot of this information. We've already uploaded many of the things onto Mighty Networks right now. So you should be getting a message maybe in the next 3 hours about the recording being uploaded. So thank you guys once again. There's no assignments for today, and we really look forward to seeing you guys next time.
And you can access Karthik's presentation on the Mighty Network. So the slides he has not been able to take up, these all are there, and we expect you to find it there. And as Amanda said, we are going to make an announcement in another 3 hours so after completing the session page. So thank you everyone for joining us, and looking forward to have a great session next week. And also soon we are going to announce our plans for the mentorship calls. So stay connected with us. Thank you so much.
Thank you. Bye.
Bye everyone.
Thank you. Bye. Thank you.
Thank you.